Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. When the markets are in turmoil, investors like to hide out in healthcare stocks. And while healthcare stocks in the US are up on a relative basis, they're still pretty down in the dumps. They've got their own headaches to deal with. One is what RFK Jr. means for the sector. Tariffs are another major concern. It's one of the reasons that Rob Moffat of Middlefield says he is remaining defensive. This is not the time to be a hero and chase some of these names lower. He talks about what he's avoiding and what he likes in this environment. And remember, if you want these pro picks right to your inbox, you can subscribe to our newsletter. Go to our website, inthemoneypod.com, and smash that subscribe button. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're a do-it-yourself investor, BMO InvestorLine Self-Directed is the perfect platform for you. With powerful tools and commission-free trading on over 100 ETFs, you'll have everything you need to take control of your investments and build a portfolio that's right for you. Learn more at bmo.com/investorline. Rob Moffat of Middlefield, thanks so much for joining me.
Thanks for having me.
So you run the healthcare portfolio at Middlefield, and that's the place that investors love to hide out when there's volatility. Except, my goodness, there's no shortage of volatility in healthcare right now.
Yeah, that's correct. I think you still need to take a bigger perspective and look at performance year to date, for example. So the market as of yesterday is down about 8.5%. Healthcare is still up 50 basis points. So it has definitely been a safe haven. Now, you are correct. There has been some volatility within the sector. There are winners and losers from this tariff rhetoric. And I think some of the most of that volatility has been in the last 2 weeks, obviously.
And do you want to get opportunistic about it, or are you staying defensive as well?
I think my advice to all investors right now is to be defensive. That's kind of the key word right now. And we're really leaning into the defensive areas within healthcare. In terms of portfolio positioning, have been reducing risk kind of across the board, selling higher growth, higher multiple stocks, and, kind of adding to healthcare services, stocks that are typically more defensive in a recession.
So there's, what's going on in the markets, and then there are specific factors to healthcare. And you mentioned tariffs as one of them, and we'll get into it. But we have to talk about Robert F. Kennedy Jr. and the impact, RFK, and the impact it's having on the healthcare sector. I don't think he calls himself an anti-vaxxer, but he's definitely a vaccine skeptic. And vaccine makers in particular are concerned about that. There's people leaving the FDA over what RFK Jr. is doing. As an investor in the space, how are you reading the RFK situation?
Well, we've been dealing with the RFK situation since November, when he was announced as the candidate for HHS secretary. If you put the vaccine views aside, I think that it's pretty clear that RFK is not qualified to be the secretary of HHS. He just doesn't have the experience. He doesn't have the expertise. I watched the Senate confirmation hearing, and he lacked a basic understanding of how the U.S. healthcare system works. So, the views aside, which are for sure controversial, I think that there's a lack of qualified leadership in the HHS. So that's a pretty difficult situation to deal with. And then, specifically, you just mentioned the FDA. I think that's probably another area that I'm a little bit concerned about right now. Since I think about February, about 15% of the FDA has left. Some people were given those offers of resignation and they took them. Some people were fired. Some people have just said, I don't want to work here anymore. So the FDA, which is really the gold standard for regulatory process and throughout the world, is in a bit of disarray right now. So it's still to be determined how that's going to impact things. We may see slower approvals. We may see, maybe the FDA, they have to do a lot of inspections of manufacturing sites. Those may take longer than expected just because of a lack of resources. So yeah, I mean, to be honest, I'm a little bit concerned about the state of affairs right now in the FDA and at HHS.
So, I mean, it's, you think he's unqualified. That's got to have a ripple effect in how you view investing in the sector that's going to be affected, particularly like the drug makers themselves.
Correct. So to be clear, we are underweight pharma stocks right now. The first move we made in November was to reduce exposure to vaccine makers. Basically, I think that along with RFK and apart from him as well, there has been a growing sense of vaccine hesitancy in the United States for the last, at least since COVID and probably even before that. So there are less people that are willing to get vaccinated now than there were about 10 years ago. So that's a headwind for companies that have significant vaccine revenues.
The question is, like, is this just a pendulum? Eventually when things like the measles come back, doesn't this remind people that, oh yeah, vaccines are generally very effective at preventing these like mid-century types of diseases?
I think most people, that would be their response. But, there are hundreds of measles cases right now, especially in southern US states. RFK, rather than promoting vaccines and telling people to get vaccinated, was promoting taking vitamin A as a solution. And then sure enough, some kids showed up in the hospital overdosing on vitamin A. So it's not good advice. It's not based on science. The scientific community has largely rejected RFK and a lot of his views. I don't want to make it sound so bad. There are other opportunities within healthcare, but right now, specifically in pharma, there are some risks right now that we're trying to avoid.
So you're not trying to be a hero in that sector. Okay, so that you've discussed the RFK headwind. Let's talk about the tariff headwind. First of all, what is the tariff situation with pharmaceuticals?
Yeah, so on April 2nd, when Trump pulled his billboard out and was putting 46% tariffs on every country in the world, he notably excluded pharmaceuticals. And there was a moment of, maybe this is a good thing, but that was quickly shut down, and it was telegraphed that pharma tariffs are coming. They're just not part of these reciprocal country tariffs. They're going to be more of the sector tariffs, which are under Section 232 of the government, which basically is instigated by the Commerce Secretary, Howard Lutnick. So I fully expect pharmaceutical tariffs to come. Normally, in order to put on a sector tariff, you need an investigation to prove that there's a risk of national security. I think we all know what the conclusion of that investigation is going to be. Usually that investigation will take about 6 to 9 months. I think in this case, we're expecting maybe 1 to 2. So there is likely a headline coming from that there's going to be a pharma tariff. My base case is about 25%, which is in line with steel and aluminum.
And that's going to make drugs more expensive for Americans, is it not?
Well, again, to be determined on that impact as well. So right now, American companies utilize a framework called transfer pricing, where a lot of their manufacturing is located outside the US. Ireland is a very popular jurisdiction because they have lower taxes and some R&D grants and those sorts of things. So US companies will produce pharmaceuticals in Ireland. They'll import them into the US, and it'll be from a subsidiary in Ireland coming in. And what that creates is a price. They pay, those companies are incentivized to have a higher price importing because they can deduct it from their income tax, where the tax is higher in the US. So if you're putting tariffs on transfer prices and these companies are purposely trying to make the price coming in higher, they're now going to have to weigh the benefits of paying higher tariffs and a lower tax bill, or maybe they will shift some production to the US and pay potentially lower tariffs, higher taxes.
I mean, that's the goal for the Trump administration, is to move production back to the US. Is it one that you think is realistic?
I think in the very immediate term, the first thing pharma companies are going to do is they're going to look at their existing footprints in the US, and they're going to see how much we can ramp up capacity here. We know we want to import less from places like Ireland. How much can we add to our facilities in Illinois and in Carolina, which are big states for pharmaceutical manufacturing? Puerto Rico is another big area. So that's why I say it's to be determined. These companies are very global, very flexible supply chains. They're built to have contingency plans in place. During the supply chain issues of 2022, pharmaceuticals actually didn't really have a lot of shortages because they were able to lean on other areas of their supply chain throughout the world to keep production going. So they do have some flexibility and some capacity to actually ramp up more manufacturing domestically before they go and spend billions of dollars on building a new plant.
So we're talking about the drug makers themselves, and maybe it's not going to be such a huge headwind. And I wonder in some ways, if you're a domestic producer already, does that insulate you? We'll talk about some of these stocks, but I remember it was J&J, Johnson & Johnson this week that says, if you're preventing foreign companies dumping cheap generics, for example, in the country, this protects our innovative drugs.
Yeah, that's right. I think for sure that the Trump administration is going to look more favorably upon domestic manufacturing. He even explicitly called out, I think it was J&J, Merck, and Lilly in his Rose Garden address on April 2nd, applauding them for the investments they're making in U.S. manufacturing. So, it's an interesting time. We don't know what's going to happen, but I could actually see some exemptions being made to companies that are investing in the U.S. and potentially they'll get a break on their tariffs, or maybe it'll be phased in over time.
We certainly saw that with Apple in tech. So I guess whoever is got him on speed dial maybe gets that exemption. We were talking about the drug companies, but there's also like a big part of healthcare, which is equipment like medtech.
Yep.
And where is their production, and could they potentially be hit by tariffs in making some of the medical devices that are used in procedures?
I would say that the production, the manufacturing of medtech companies is fairly similar to pharma companies in that they're taking advantage of transfer pricing. They're using lower tax jurisdiction and importing. They also have a big domestic footprint that has flexibility. So there's not a huge difference in the dynamics there. The one difference is they're not facing a 25% tariff. So medical devices aren't being tariffed. They may not have to worry about their existing footprint in Ireland, and they may just be business as usual. Now, one more thing that's very important to recognize for both pharma and medtech companies is that they have very high gross margins, meaning their revenue minus their cost of goods sold is around, for medtech companies around 70%, for pharma companies around 80%. So even if there are tariffs, these are high margin businesses that it's not a huge expense item. They spend more on R&D and on SG&A and other things lower down in the income statement. So, I do think that insulates them quite a bit from these tariff impacts.
It's interesting. So they have these large margins, but so much historically of growth in the sector has come, through innovation, but also through M&A. There's just so much uncertainty. I don't even think uncertainty is the right word. It's just like the outright chaos right now. What does that do for M&A? Do you think there's an opportunity for like a cashed up company to take advantage of some of these dislocations out there?
I think M&A in the pharma space is definitely coming. There are, a list of companies that have significant patent expiries over the next 5 years. And quite frankly, their pipelines you can see there is not enough to backfill that lost revenue that's going to come. So they have very few options, and certain companies like Merck and Pfizer have recently been very explicit that business development or M&A is a part of their growth strategy. So they're known acquirers. There will be deals. I think that the bid-ask spread between these acquirers and the biotech companies that, have a gem prize that they want to sell for a premium, there's still a pretty big spread there. But, biotech, especially mid-cap biotech, has really had a tough time this year. So that spread may be narrowing, and I would expect some deals to come soon in pharma.
Do you traffic in those smaller biotech companies?
Right now, no. As I mentioned, we've been de-risking. To start the year, we did own a handful of mid-cap names, kind of smaller positions in higher risk companies. M&A thesis is sometimes a part of the story, but usually it's based on a clinical catalyst or a regulatory or a new product launch, for example. But we do, and we're still looking at them, still monitoring them. But just in the spirit of us de-risking and kind of focusing on quality right now, we don't have much exposure in the portfolio.
All right, well, let's talk about some of these stock ideas and dip into the mailbag. Our first question, you know this is coming because whenever I'm with you, I ask you about this privately. This one came from Doug in Winnipeg, though. Pfizer has not been able to keep pace with rivals like Novo Nordisk and Eli Lilly on obesity drugs. What's your outlook for the stock? It's trading, I think, around the lowest level since 2012. And I know that because I'm a shareholder.
Since 2012?
No, God, no. I came in, I bought the dip and I thought, well, I came in before the activist investor just because I thought, my goodness, it's trading at the lowest level since 2020 at that time.
Yeah.
So I caught a falling knife, as it were.
Yeah. Well, I was just discussing the patent cliffs that some companies are facing, loss of exclusivities. Pfizer is one of, if not the biggest candidates for this, where they have basically the key products in their core portfolio are going off of patent over the next 3 years. So they need something to happen in their pipeline. They just had a pretty substantial failure on Monday where they basically pulled the plug on their oral GLP drug. They do have some interesting candidates in oncology, but most of those don't really read out until 2026. So there's a bit of an air pocket between now and when the pipeline actually might kick in. So I think Pfizer is at the top of the list for a company that's going to do some business development later this year.
Do they have the financial flexibility to do that?
So I want to be clear. We don't like Pfizer, don't own it, don't recommend it. Every time I see you, I say I have the same message. I think the one thing that would get me to change my mind on that is a change in management, because this company has really proven to make poorer capital allocation decisions. If you think about the tailwind they had during the COVID pandemic, I mean, they were generating tens of billions of dollars in COVID revenues from the vaccine and from Paxlovid that they didn't allocate properly. They now have one of the most levered balance sheets in all of pharma, even after, call it $100 billion of extra revenue in a 2-year period. So totally squandered that opportunity. They'd made a big acquisition, I think in 23 of an oncology company called Seagen, which was, it adds revenue, it adds some good products, but they paid full price. It was almost a $40 billion deal. So I think that for me to change my tune on Pfizer, I think there needs to be a shakeup at management. I'm not alone in that.
There's an activist investor, Jeff Smith at Starboard. That's part of what he's pushing for. My hopes are riding on Jeff Smith being able to do something. But as an investor with real dollars at work, is that a catalyst for you at all, or do you just kind of watch that as a sideshow until you see change?
Yeah, I think so. The stock's at about $22 right now. I think you could trade it. It could go up to 25. That's probably where the fair value is. That's where it was a few weeks ago before this failure and these pharma tariffs. So there is maybe a short-term trade in it, but if you're a longer-term investor, I don't see the long-term catalysts in place. And just because the stock's cheap, that's not a thesis on its own. I know that it's trading at 8 times.
And you'd be lured by the dividend, like a sucker.
The dividend's almost 8% right now, and looking at the numbers, the payout ratio on that should be around 100% this year and declining. So I don't think they're cutting their dividend. They recognize that a lot of their shareholders are in the name for the dividend. So, on a short-term basis, you have a bit of upside in the stock price to the mid-20s. You get the dividend, but I'm seeing better opportunities elsewhere in names that have sold off.
Okay, let's move on to UnitedHealth. This one became such a controversial name, but actually the stock is up recently, up more than 15% over the past month when everything else is down. Is the stock a buy here? This question coming from Russell in Ottawa. The drama, of course, is that a subsidiary CEO was shot, assassinated, and typically that doesn't cause a sell-off in a stock, but it was more about the moment, right? And it was about, exposing the tactics of UnitedHealth and denying medical claims and questions by investors about what is this going to spark? And now the stock's back to where it was before that event.
Yeah. No question, the assassination of the CEO of United Healthcare shone a light on some of these claim denial practices that United and the industry as a whole carry out. I think that United can do better on that front. I think that it's difficult to get something reimbursed, and there's a lot of paperwork and bureaucracy, and they don't make it easy to just walk in to a provider and get the healthcare you need. So I think.
Don't you as a shareholder want that though? Like, do you have dissonance about that?
Of course. I think that they're making some of the right steps. Now, there is an investigation going on right now with the Department of Justice. We'll see if there actually is some real litigation issues. There's precedent for this where, there's probably they'll pay a fine. It's very manageable for a company of United's size, but that's kind of they have a PR problem. They're definitely out of favor with the public, and that is an issue. Now, on the other side of things, I do like this stock, and we own it, and it has performed very well the last few weeks as a safe haven trade.
Did you buy it? Have you held it through this turmoil? Did you take advantage of the sell-off?
We've basically held it through the turmoil. Haven't really traded around it much. United is the biggest and best company in managed care. They have a leadership position in Medicare Advantage, Medicaid. They have a good private insurance business. They have a PBM. They have a great
pharmacy benefit manager.
Sorry, thank you. They also have a business called Optum Insights, which is kind of data analytics and AI driven. So United has a lot of really good businesses as a whole. And really other than the things that were in the news that caused the stock to sell off, I think the biggest reason why United was struggling last year was because of the utilization environment in healthcare. So insurance companies reimburse people for healthcare that they consume. In 2023 and 2024, people were consuming much more healthcare than they were in the years prior. That was a bit of a backlog from COVID. It was a good economy. Under the Biden administration, there was a lot of stimulus and expanded coverage. So people were going and consuming, and United was having to pay that. So that created pressure on United's insurance business. It created margin pressure. If you look out over the next 2 to 3 years, that headwind is going to become a tailwind, and they're going to be growing their earnings in the mid-teens again. So when you consider that, just kind of this headwind now back in the rearview mirror, I really like the earnings outlook for United.
Let's move on to CVS, because I think they might have benefited from some of the shift as well, because they're also a pharmacy benefits manager. Our next question is from Debbie. What does Rob think about CVS? Does he like the stock, and would he buy it here? And this is a falling knife I did catch, and I've done very well on it. But I bought it at a time where it was at a multi-year low.
Yep.
This and Walgreens have really struggled, but it's recovering a lot better than Walgreens is. Backstory CVS for us and bring us to where we are now.
Yeah, well, the backstory is that, starting in the 2010s, it was clear that CVS was facing existential secular headwinds from the corner store pharmacy business. Retail pharmacy there was less foot traffic, there was more e-commerce activity happening, so the company needed to do something. So they went out in 2018 and bought Aetna, which is an insurance company similar to United, one of their competitors. And then over the last 5 years, they've bought some other business as well. So a primary care business, an in-home health business, basically trying to become more vertically integrated and more of a one-stop shop solution for healthcare. So I think that is a great long-term strategy. That's the right thing for CVS to do. If you're asking me if I think that CVS is going to be in a better place in 3 to 5 years, absolutely. I think that they're doing the right things. But this is for one of the biggest show me stories that exists in healthcare right now. If you look at, I was just talking about the utilization dynamics last year. It caused CVS to miss earnings for 3 consecutive quarters. That's unbelievably bad execution. I think at the end of Q4 last year, they had a big management change, got a new CEO. Last week, they announced a new CFO. So you have a new management team in place. They've guided relatively conservatively for this year. I think that they can meet or exceed guidance. So I do like the setup, but it's just, fool me once, fool me twice, fool me 3 times last year. Like, this company has certainly stumbled a lot. So I'm waiting to see if they can start executing.
So it's on the watch list. One thing, and this also maybe pertains to UnitedHealth, but there were also concerns maybe about reimbursement rates that the government was giving for some of those government administered medical programs. Was that a factor in CVS, or did that more weigh on UnitedHealth?
I think the biggest headlines have been like are you talking about with pharmacy benefit managers?
Yeah. I think so. Like, was it the Medicaid reimbursement? That weighed on the side, like took Elevance down and all of them.
Yeah. So I think what you're referring to, and this is definitely still an issue, is that the Republican government needs to extend Trump's tax cuts. There's about $4.5 trillion of cost there. If you add in the service tax on tips and the not taxing Social Security, you're over $5 trillion. So the government's now looking around for pay-fors. They need ways to pay for these tax cuts. And as they look through the budget, Medicaid is a very big line item. It's about, almost $1 trillion a year it gets spent on Medicaid by the government. So what is being discussed is potentially cutting Medicaid. And companies like CVS, Elevance, United, they have patients that they represent in the Medicaid world. So if their funding is getting cut, they're going to have less patients, less business, basically. So that is still to be determined. We still have to go through the budget reconciliation process. That probably takes us through the summer. Now, I will say cutting healthcare is not a popular political move. I think that Republicans are getting a lot of pushback from their constituents saying, like, you can't cut, I'm on Medicaid. Are you actually going to cut this? This is a very unpopular idea. So how they're approaching it is through this angle of fraud and abuse. They're going to install work requirements, for example, where if you don't have a job or you're not looking for a job, you won't be eligible for Medicaid coverage, which actually could save the government some money. So that is coming. There are cuts coming to Medicaid, but I think the magnitude of those cuts is much smaller than we thought it would be a couple months ago.
We're going to take a quick break and get back to more of the questions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back. We are still in the mailbag. We've got a question on Medtronic. This one is coming from Tim in Ottawa. I'm interested in Medtronic because of the dividend. What is your outlook on the stock?
Yeah, we like Medtronic. We own it, have owned it for a long time. Medtronic, similar to CVS, went through a bit of a strategic shift, but that began about 5 years ago. So they're several years down the road or further along than a turnaround story like CVS. Some of the things that they were focusing on that time was streamlining their business. This is the biggest med tech company in the world. They sell a lot of products and they're in a lot of different areas. So what they did was they cut or did some non-core dispositions of lower growth, lower margin businesses, and they refocused their R&D towards higher growth, higher margin opportunities. So that is certainly the right strategy. And we're now starting to see signs that is bearing fruit. So Medtronic has a couple of key products that are starting to do well. They're kind of in the early phases of their launch. But for example, in TAVR, which is transcatheter aortic valve replacements, Medtronic is definitely a legitimate competitor and taking share from the industry leader Edwards. In pulse field ablation, Boston Scientific is the leader, but Medtronic has a competitive product. They have a robotic surgery system that's competing with Intuitive. So in a lot of these markets, they're kind of second place, but it does look like they're taking some market share. So I think that, given that backdrop, and then if you just look at what you're paying for Medtronic, you're kind of getting mid-single digits revenue growth, high single-digit EPS growth. It's only trading at 14 times earnings. So a nice GARPy stock for you. Growth
at a reasonable price. It's pulled back in the last month. Is that tariff concerns? Are there tariff concerns here? And I guess it sounds like you would add on this pullback.
I would. I like it here. That is probably tariff concerns. So Medtronic has unlike most med tech companies, or relative to other med tech companies, I should say, they have more exposure to markets outside of the US. So if there are, for example, if China shuts the door and say we're not importing anything anymore, then Medtronic, that's a market for them. Europe is another one. So they are a little bit more exposed to the international trade war that's going on.
What do you see as the risk, though, of that?
I think the risk, like I was saying earlier, a company like Medtronic has a very global and complex supply chain where a lot of things move around. So the basic risk is that if there's higher tariffs on any border, then they're going to have to pay. That's going to hurt their margins. That is the risk. But a company of Medtronic's size, they can kind of reconfigure it and try to lean on certain areas, pull back on others, and try to minimize this tariff impact.
Okay, sticking with medtech, we got another question. This one from Amir about Stryker. What is your outlook for Stryker? Do you like the stock? I'm considering buying here. Again, another stock that's pulled back over the last couple of weeks. Tariffs again?
I think with Stryker, the pullback is a little bit more related to the cyclicality of the business. So Stryker sells, compared to Medtronic, which sells more lower capital equipment, Stryker sells a lot of stuff that's sold into the operating room. On the high end, that includes surgical robots and orthopedics, which are very expensive. And they also sell beds that are robotic and rotating. And then they do sell lower capital equipment as well, like scalpels and those sorts of things. But overall, for Stryker to work and for their business to work, they need hospitals to be spending money. They need hospitals to be ordering more robots. They need them to be doing more procedures. And this is definitely something that's reliant on a good economy, a good utilization environment. So I think that in a recessionary scenario, or as we were talking about, in a scenario where the government's cutting funding to Medicaid, that potentially poses some risks to how much money hospitals are going to be spending on Stryker's products.
We're going to be talking about weight loss drugs in ProPicks, but I want to bring it up now as it relates to these med tech companies, because one of the side effects of these weight loss and obesity drugs and diabetes drugs is you're healthier. You require fewer procedures. You might not need that knee replacement because you've lost 50 pounds instead, or you don't have heart disease. So, just demand for those surgeries, maybe not tomorrow, but in the long term goes down. How do you as an investor in the space think about that?
I actually think it's the opposite. I think that you're right. People that are on GLP medications are healthier, but that allows them to go out and play pickleball and play golf and go hiking. What happens when you do that? You twist your ankle, you sprain your knee. They're actually more active now as a result of losing this weight. So I would take the other side of that argument. Stryker has advocated for this as well, and I believe them. I think that it's true. And then the other thing is that some patients were not eligible for surgery before being on a GLP-1. They had too high of a body mass index. There was too high risk of a surgery. Having lost some weight now and becoming healthier, they're now eligible to go into an operating room and get a knee or hip replacement. So there actually are some GLPs are complementary, I would say, to surgeries and to medtech.
Let's end here with Johnson & Johnson. Just delivered a strong set of quarterly results. But tariffs showing up here, how might that affect the company? What are your expectations? This question coming from Jesse in Vancouver.
Yeah, so J&J on their earnings call yesterday actually said they reaffirmed guidance, and they said that they had incorporated the impacts of tariffs into that. So that is a huge win. I don't think every company is going to be able to do that over the next few weeks. So again,
which basically means like the profit outlook that they had before tariffs is the same, even though now they've included the impact of tariffs, because how? They're going to tinker with something within the business.
It may be some supply chain things. And the other lever that a lot of these companies have to pull, I think the biggest lever they have is R&D. They spend a lot of money on R&D. On average, a pharma company will spend about 20% of their revenue on R&D. In some cases, it can be 30% or higher. So they will probably have to streamline that revenue, that spending a little bit, and potentially reduce it. And that's just a short-term lever they can pull, but it does allow them to kind of pull some strings and still squeak out a guidance meet.
So you like J&J here?
I do like J&J. J&J is kind of since they sold off their consumer business a couple years ago, they're now basically about 60 or 70% pharmaceuticals and then 30 or 40% med tech. I really like the pharma business. I think they're doing a good job. You saw in the quarter on Tuesday, a lot of their products are beating expectations. They're growing well. They're getting good uptake. I'm a little bit more concerned about their med tech business. Names like Medtronic are taking share from J&J. They're one of the share donors in this situation. So, overall, it's not my favorite name. I think there are better names in pharma and in med tech. But if you're looking for a safe, defensive kind of a company that can smooth out earnings and still meet guidance, like it's definitely not a bad stock to own in this environment.
All right, well, let's find out where your conviction is and get into pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, we saved this because in a healthcare chat, we should be talking about the diet and obesity drugs because for a long time, those performers were, insane. You double, tripled your money. But now those have come off, and your top idea, one of them is Eli Lilly, which of course is on the forefront along with Novo Nordisk, which makes Ozempic, of these diabetes and weight loss drugs. But it's come off quite a bit.
It has. This is definitely the longest I've talked about healthcare without talking about weight loss drugs. So that's good. It's nice to talk about the other areas of the sector. But yes, certainly the most topical area in healthcare right now. And Lilly is my top pick, top holding in our funds, because it is in the leading pole position in the fastest growing area in all of healthcare right now. If you look at their earnings growth over the next 5 years, they're probably going to be growing earnings at least 20% per year. Right now, they're generating about $35 billion in obesity and diabetes revenues. That's going to at least double over the next 3 to 5 years. So there is huge growth from Lilly right now.
So why has this and Novo Nordisk pulled back?
I think the biggest reason the last 2 weeks has been tariffs. Pharma companies are being sold. They're not as safe from, normally in a recession, in a kind of typical recession, pharma companies would be very safe. You look at the GFC, they still were able to grow earnings throughout the worst recession in modern history. This is a little different with the tariffs. So I think that's the biggest reason that they've sold off.
But they were selling off before.
Well, Lilly missed their guidance, or they missed their numbers in Q3 last year. They reported in Q4, but they overpromised and underdelivered in the second half of last year. The biggest reason for that was they had, I think, underestimated this stocking and destocking environment where customers will order a lot in advance, and there were supply chain issues as well. And then in the next quarter, they weren't selling as much because people were just getting rid of inventory. And
I should say, Lilly, it's sold off. It's down about 20% from its peak, and it's been volatile for the last year. Whereas Novo Nordisk has just been a one-way ticket lower. It's down about 60% from its peak in 2024. Why is that? And do you have a preference for Lilly over Novo?
I do. It's really an unbelievable fall from grace that Novo has had, like you said, down 60% from its peak. And the biggest reason for that is that, well, there's kind of two. One, Lilly has better drugs. They are more efficacious. They have similar safety profiles, but they have a better product. A lot of people have heard of Ozempic and Wegovy, but not a lot of people have heard of Lilly's drugs, which are Zepbound and Mounjaro. But they're actually now, as of a couple weeks ago, Lilly has taken a larger share of the market. They're over 50% market share in this asset class now. So they have better drugs. And the other thing is that they have a better commercialization strategy. They have, obviously, they're doing less direct to consumer marketing, but they're proven to be very effective in marketing to physicians. Every physician I talk to, not just whether it be a primary care or a cardiologist or basically anybody, they can't prescribe enough of these drugs because it not only treats diabetes and obesity, which are massive chronic illnesses, but it also reduces the risk of heart disease, of sleep apnea, of chronic kidney disease. The list goes on, and it's now being studied in Alzheimer's and all sorts of other things as well. So, all that to say that this opportunity is huge, and Lilly has the better mousetrap to address it.
Your second pick is Abbott Labs. This one obviously was a very big pandemic darling because they were making the testing kits, and then it has come off. It actually just reported results though, and the market is greeting it very well. I'm sure you're happy about that as a shareholder. What's the Abbott Labs story today?
Yeah, a little bit risky making a top pick, something that was reporting earnings this morning, but they pulled through for me and the stock's up about 5%. So happy to see that. The way I would describe Abbott is that some similarities to Medtronic in that they're a large, diversified medtech company. But the difference is that medtech is only about half of their business. They have another half of the business, which is it's a little bit lower growth, but it's more stable and predictable. So they have a nutrition business, they have a established pharmaceuticals business, and they have the diagnostics business, which obviously went gangbusters during COVID. But they're a little bit more diversified than a pure medtech company. What's most exciting about Abbott, though, is definitely the medtech business. They are, I would say, they used to be the number 2 player in diabetes in CGMs, continuous glucose monitors for, people with diabetes.
That's sort of my new thing. I feel like it was step counting, and now everyone's talking to me about continuous glucose monitoring. Right. And I don't have diabetes, but I did it just for fun, just to see how do I react to certain things that people say are bad for you.
And what product which device did you have?
It was Abbott. The
Lingo?
Libra?
Lingo?
Is Libra?
Well, Libra is prescribed for diabetics.
Oh, okay,
Lingo
then it
is
must
over
have
the
been
counter.
Lingo. It's the over-the-counter one. It's the over-the-counter one.
Yeah. So it used to be perceived that Dexcom had higher accuracy. It was kind of the Cadillac of CGMs. Abbott has really caught up in the last few years. Their Libre 3, which they launched last year, is as accurate. If you talk to endocrinologists, they'll tell you, I don't really have a preference. And in fact, a lot of patients find it easier to access the Libre. It's a simpler interface. They can get it from the pharmacy. So there is a bit of a preference for Abbott. So this is a story of Abbott taking market share from Dexcom, the market leader. And, they reported this morning, diabetes grown almost 20%, and it's 16% of their business. So it's a material product for that.
How can you like something that Eli Lilly, which, helps to treat diabetes, and then one that is meant to capitalize on the growth of diabetics? Yeah.
So I think, well, first of all, the patient population, the opportunity in diabetes is so big that we haven't even scratched the surface in terms of market penetration. There's 500 million people in the world with diabetes. 40 million of those people are in the US alone. And we're not even close to that many people on CGMs or on GLP-1s. So both companies have a lot of room to grow. I think that what GLP-1s are doing is they're shrinking the funnel for people that are pre-diabetic that are actually going to fall into diabetes. Those people are still probably good candidates for CGMs, where they need to monitor their blood glucose levels. They need to watch what they're eating and their exercise. They still need to know because they're at higher risk of diabetes versus someone, that's basically a bigger risk to pump makers, which have pumps that produce that's for people with diabetes that rely on insulin. Whereas I think Abbott has a place in the world or for people that don't necessarily need insulin, but still need to monitor their A1C levels.
So you think that singular catalyst, well, I know you said it's diversified, but that's kind of a next big catalyst. How big do you think that business gets for Abbott?
It's about $2 billion a quarter, so $8 billion a year. I think that business, similar to, it probably doubles over the next 5 years. There's a huge opportunity. The type 1 population in CGMs is quite penetrated. There's a lot of people, if you have type 1, standard of care now is that you're on a CGM. Type 2, there's different kind of categories of people with type 2. Some take daily insulin, some take it in the morning just to keep their levels up. Some people don't take insulin but still need to use a CGM. as you go down these different, the risk spectrum of these populations, there's less and less penetration. So Abbott needs to focus, and they've proven to be successful in some of these further down market opportunities.
And then there's tourists like me who don't have diabetes. It's like, let's just slap this on for fun. And it's so easy. You just put it on your arm and then you can check it with your phone.
That's right.
Anyway, it was a lot of fun to see the spikes and like, oh, I can eat this and I'm totally fine. Let's squeeze in your third pick here. This one is McKesson. Why is the stock held up so well?
Yeah, so McKesson is the ultimate defensive safe haven company in healthcare. It is clearly a place where people are hiding right now. You could argue a bit of a crowded trade, but I do think that in this market environment, this is a great name to own. There's still room for more multiple expansion, and I really like McKesson. So McKesson is one of the big three drug distributors in the US. It's an oligopoly. Basically what the distributors do, or the wholesalers, some people call them, is they buy products in bulk from drug manufacturers. They store them, they ship them and handle them, and they deliver them to providers, hospitals, pharmacies, places that prescribe drugs. And they take a spread on that transaction. Between the three companies, they touch over 90% of medicine in the US. It's a very sticky, stable business. The margins are low, but they're very consistent and very reliable. What's interesting about McKesson is that they're growing their specialty business quite rapidly. And what that means is drugs that require more than just putting a box in the back of a truck and taking it to a pharmacy. Specialty pharmaceuticals can need sterilization. They may need cold storage. They may require, they may be narcotics, so more security requirements. Basically, they're charging a premium for the specialized handling of certain products. GLP-1s fall into that category. So the more GLPs that are consumed, that they're a beneficiary of this. And all of that is driving a much better growth profile than what we've seen from these companies in the past few years. So McKesson's going to grow their earnings about 12 to 14% a year. That's their long-term target. It's trading at about a below market multiple right now. So I do think that that's still quite attractive growth for a reasonable price.
Do you still see more upside, even though it's done so well relative to the market?
I do. I don't think this stock doubles, but I do think that it continues on its current trajectory, which is, if you look at the chart, it's up and to the right for several years. So I think that has some momentum, and I think that trajectory will sustain itself.
Rob, this was so fascinating. Thank you so much.
Thanks for having me.
Make sure you come back on when you're ready to recommend Pfizer again. I need to know about it. Thank you so much. That's Rob Moffat of Middlefield joining us. Make sure you join our next episode. We've got Liz Miller on the show of Summit Place Financial. She's talking pretty much any North American large cap, so you can get your questions in to questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. You can also submit via our website, you guessed it, inthemoneypod.com, and we'll catch you on the next episode.